He kōna ipurangi tēnei nā te reo irirangi o Aotearoa.
Welcome to No Stupid Questions with Susan Edmunds, the podcast where we try to get you answers to all the money questions you've ever wanted to ask, and maybe some you haven't even thought of yet. We really appreciate all the questions that have come in so far. We can't give personalised financial advice, but we're here to weigh in on whatever's on your mind as long as it relates to money. I'm ably assisted, as always, by Justin Gregory.
Hello, etc. That's what it says in the script. Hello, etc.
It is. Well done. What with new inflation data, the IRD chasing everyone for their tax debt, and some more banks cutting interest rates, it's been a busy week for money news, but then I guess I say that every week. So to start this week, we've got a question about mortgage broker fees.
That's right. Ian wrote to say he noticed a story you wrote about mortgage broker fees being clawed back. Can you just quickly paint a picture for us here? What's going on?
Yeah, so I wrote a story about a case that Financial Services Complaints Limited dealt with. They're one of the dispute schemes that handles complaints about financial services when they can't be solved by the provider directly with the customer. So in this one, someone had applied for a home loan, then wanted to borrow more money, couldn't get it from the bank he was with, so he went to a new bank. But then he was angry that his broker charged him $2,500 because the broker's commission was clawed back by the first bank that he was with. They can call back any commission that they've paid if people move within a set period of time.
So Ian is saying if a broker is getting paid $2,500 by the bank to supply a customer for a mortgage, then why can't that person, the customer, go directly to the bank and ask for that $2,500 as a discount for supplying themselves as a customer? Have I got that right?
Yeah, that's right. And it's something I have heard before, and it's an interesting one. I guess there are a few parts to it. So David Cunningham, who is chief executive at Squirrel, which is a mortgage broking firm, I should say, but he's also been a bank chief executive in the past, says mortgage advisors take on a lot of the work of putting the loan in place that the bank would otherwise have to have its staff doing. So he says if you go direct, the bank needs to have qualified staff to help with things that your mortgage advisor would do. A good one will do lots of hand-holding through the buying process, particularly if you're a first home buyer. And he says generally banks find it cost effective to outsource that to a third party who only has to be paid if the loan is drawn down and who is also qualified to give advice, which has become a bigger thing in recent years. And he says if you're happy to do the negotiating, organising and applying yourself, then you can go to a bank directly and ask for a deal, see what they say. The other thing, I guess, is that when brokers are bringing loans to the bank, they don't have to advertise as hard to get people in the door in the first place. People do think of mortgage advisors as a free service, I think, which they obviously aren't, and they have got to be paid from somewhere, but there are some limits to what they can charge if they have their commission clawed back. From memory, I think that works out to be about a maximum $3,000, but that's probably one I should check. The commission the bank pays might be something like 0.9% of the loan if they only do upfront commission, which some banks do.
Our next question continues this housing theme. Andrew wants to know, what does the bank of mum and dad mean? Is this when you're using equity in the family home to help kids buy a home, or is it something else? Is this just a bigger loan instead of saving for a deposit?
Yes, so mums and dads, what are they doing? Investing and offering, becoming banks. We love to talk about mums and dads, but when we talk about the bank of mum and dad, we're usually talking about parents using their own home or other investments to help their kids get into their first house. So it's a pretty significant boost for some people. There have been estimates that I've seen over time that parents in New Zealand have handed out support that's equal to more than $20 billion. And it's often used by people who don't have 20% deposit, or in other words, that 80% loan to value ratio. And that's because once you get to that 20% level, it can be a lot easier to borrow money and you get access to better interest rates, lots of good things like that. So if your parents can give you a helping hand to get there, it does make sense. I talked to mortgage broker Bruce Patton about this, who explained there are a few ways that parents can do it.
Yes, so effectively, yes, it is just a bigger loan, but the kids have to have some deposit. All the banks have different rules, but generally the parents can't be a guarantor unless the kids have some sort of savings. Yeah. Normally the expectation is they'll have 5% genuine savings, which can include KiwiSaver.
But as for the second part of the question, if you're borrowing against your parents' equity to get into a house, you will end up with a larger mortgage.
Parents could borrow the money and lend it to the children on the basis the children pay it back in the future when the house is sold, or they could be a guarantor. So they could basically say, we are going to tie $100,000 of our equity plus 2 years interest and cost. So the guarantee is not just limited to 100,000. It's 2 years interest plus cost. So it might be for 125,000. And what that does is it then balances the loan to value ratio with the bank for the kids to be at that perceived 80%. So they might still have a $900,000 loan, but the equity is now 1 million plus the guarantee the parents are providing. There are some catches to it though. And so one of the catches is the parents need to be able to show their ability to service the guaranteed portion. So if the parents are retired, they own their own home and it's freehold, but they have no other cash, they have no other income, the bank won't see them as a strong candidate as a guarantor. And that all came about when they changed all the legislation around the triple CFA and making sure that, like banks just used to willy-nilly grab a guarantee and they only just linked it to equity. They never linked it to any income. But with all the legislative changes that have come on, so parents are not always able to be a guarantor. So sometimes they might need to lend the money to the children if they have physical cash, and then they could do a side agreement for a deed of debt that says, there's no interest payable, no repayments, but you will pay the money back upon the sale of the property in the future, or it's an early inheritance. There's any number of different weird and wonderful ways that it can be done.
And third question comes from John. He wants to know, this is a good one. How can one be sure when you're buying gold online via an ETF, we'll ask what an ETF is later on, that there is a physical amount of gold actually stored in your name? Now, this has come up before because Gold Corp in the late 80s, they sold gold certificates to investors, but there was no actual gold to cover all the clients' allocations. And we found that out when the company collapsed. Is that right?
Well, I don't remember a lot of the late 80s because I was about 5, but gold is very topical at the moment, so it's probably something that lots of people are thinking about. It's one of those assets that's seen as a safe option when markets get a bit tumultuous, as they are at the moment. Rupert Carline, who is the founder of Quarter Wealth, said gold funds would be audited. In the case of the iShares ETF, it's audited by Deloitte, he says, and that would ensure that they have the physical gold holding that they claim to. He says Deloitte will need to verify that the gold exists, and it will need to find a way to confirm the value as well. He says he suspects they will actually go as far as visiting the vault and looking at the stuff. But if you really want to be able to touch and feel the gold yourself, you can actually buy it. Rich Elliott at My Gold tells me that the business was founded to be able to give people physical metal to hold in their hands if they want to. Although he notes at the moment that it's actually quite hard to get your hands on the stuff because demand is so high, and it's the same for silver as well.
Winding back to the start of this question, what is an ETF?
An ETF is an exchange-traded fund, and it's a fund that's designed to mirror a market index, basically. So you're not trying to select stocks to outperform the market, you're just tracking the movement of a part of it.
Now, on to our bigger question for this week. We get a few questions about superannuation every week.
Yes, lots of questions about superannuation. Some of them are a bit specific, so it takes me a while to get into the details to get an answer, so some of them might still be coming. But one of the things that has been a big theme over the past year is how long you can leave the country while receiving NZ Super and still get it. Some people were surprised to know that if you go overseas for a long period, your payments could stop.
How long a period are we talking? What's the time limit?
So if you go overseas, your pension continues as normal for 26 weeks, then you have to be back within 30 weeks. And that isn't cumulative, so you can go away and come back and then go again. But if you're going for longer, in some cases, you might be able to arrange to have the payments continue, but it does depend a bit on the social security agreements with other countries that we have and that sort of thing. And you do need to sort that before you go.
Has there been some controversy here?
Yes, people are surprised that there's a limit at all, actually. There's that sense that persists that NZ Super is your own money that you've paid for in taxes over your life, even though that's not actually how it works. And Shamabil Yaqub, who's now chief economist at Simplicity, says it shouldn't be an issue because there are limits on all benefits when it comes to travel, and super is just another one. But, it is thought of differently, I think.
It is. Now, we also get questions coming in from people who, harking back to that earlier statement, who want to know what will happen to their pensions if they move overseas permanently.
Yes, and again, this depends on what agreement New Zealand has with the country you're moving to. If you move to Australia, for example, you can probably use your New Zealand residency to meet their residency test, but you'd still need to meet the income and means tests that they have. So theirs also doesn't start until you're 67, which is worth keeping in mind.
And there can also be issues for people who move to New Zealand with an overseas pension from some other country.
That's right, we hear from a few of these. So depending on where you're coming from and the type of pension you have, you can find that your ability to get New Zealand super is reduced by the money that you're getting from overseas. So I hear from people quite often who are upset that their super is being reduced by payments from the US and places like that. And it depends on whether the government thinks that the pension you're getting from another country is the same sort of thing as New Zealand super. And it's that definition that gets a bit confusing, I think.
I don't think this is going to be the end of these questions, is it? There's going to be more about superannuation in the future.
I think there's a long-running well of concern about this that will keep coming towards us. So last week we asked you which country was the first to introduce paper money.
I had no idea, but Susan looked it up and the answer is China. China, which was using it for the first time in the 7th century.
So now this week we're asking you, who was the first billionaire in the modern sense of the word?
And emphasise the modern sense of the word. We're not talking about ancient Roman emperors or Genghis Khan or any of those vastly, stupidly wealthy people. We're talking more your Elon Musk type, the modern sense.
Yes, the capitalist billionaires. Send your answers to questions@rnz.co.nz, as well as any other questions you might have about money. As always, thank you so much for listening. Please follow us on your favourite podcast app and give us a review to help others find us.
No Stupid Questions with Susan Edmunds was written and presented by Susan Edmunds. Justin Gregory is the producer. The engineer is William Saunders. Thanks to Ian, Andrew and John for their questions, and David Cunningham, Bruce Patton, that's me, Rupert Carlyon, Rich Elliott and Shamabeel Jacob for their answers. Follow and listen to No Stupid Questions with Susan Edmunds on Apple Podcasts, Spotify or any podcast app so you don't miss an episode.